All right, welcome back to Talk Tickers.
Good to be here.
Yeah, so for everyone tuning in, we're doing a deep dive today. It is Thursday, February 26th, 2026.
And if you've been watching the tape, specifically the after-hour session...
It is a sea of red.
Exactly. You're likely staring at your screen, wondering if the algorithm just broke or, if the street knows something that you don't.
Right, because on paper, it's one of those prints where the headline says party, but the price action says hangover.
That is the perfect way to describe it.
So our mission today is to strip away all that corporate fluff. We aren't just reading the press release.
No, we're reading the footnotes. We are dissecting Synopsys, ticker SNPS.
Right. This is their Q1 fiscal year 2026 print. And honestly, this is the quarter we have been waiting for.
The big unveil.
Yeah, ever since the ink dried on the Ansys deal.
It really is. This is the first real look at the integrated company. We're finally seeing that $35 billion acquisition fully consolidated.
$35 billion?
Yeah.
That's a massive pill to swallow.
It is. And we are testing that whole silicon to systems thesis against the cold, hard reality of a P&L statement today.
And what we have here is a textbook beat and drop scenario. I mean, they beat on the top line. They beat on the bottom line. They even raised full year EPS guidance.
They did.
And yet the stock is trading down roughly, 4 to 6% in the extended session.
Last I checked, it closed around 449, and we were testing 430 in the after hours.
Right. So we need to figure out why the market is aggressively fading this news. Are we looking at a buying opportunity here, or are there cracks in the foundation of this whole chip design monopoly?
There are definitely cracks.
Really?
Yeah, but they might not be exactly where people assume. It's a really nuanced story about margin mix, the actual quality of these earnings, and a very specific nasty drag in their IP portfolio.
Okay, let's start with the raw numbers then. Give me the snapshot.
The headline is a solid beat. Non-GAAP EPS came in at $3.77.
And the consensus on that was around $3.56, right?
Correct. So that's a 21-cent beat, very robust on the surface.
And year over year.
Up significantly from $3.03 last year.
Okay, so earnings power is obviously growing.
Right, but we have to talk about the GAAP numbers for a second.
Because there's a huge delta there.
Massive. GAAP EPS came in at just 34 cents.
Wait, 34 cents. Down from 3.77.
Yeah, because when you swallow a $35 billion whale like Ansys, the acquisition costs and the amortization just completely wreck your GAAP metrics.
Right, all the accounting noise.
Exactly. But even looking at the clean non-GAAP numbers, we really have to look at the quality of that beat. Things get murky when you dig into the guidance.
Yeah, let's skip to the guidance because I feel like that really colors the whole market reaction today.
It's the tell.
They raised the full year EPS outlook to a range of 14.38 to 14.46. That's an increase of about 6 cents at the midpoint. But where exactly did that 6 cents come from?
That is the multi-billion-dollar question, isn't it?
Right.
And to be fair, management was remarkably transparent about it, almost to a fault. That raise was not driven by selling more EDA licenses.
Okay.
It wasn't driven by an unexpected surge in Ansys adoption. It was entirely driven by, quote, lower net other and interest expense.
So financial engineering.
Effectively, yes. They paid down debt faster than expected.
How much debt?
$4.3 billion in term loans. Just wiped it out.
Wow, that's a huge chunk of change.
It is. And obviously, that saves them a ton in interest payments, and those savings flow straight to the bottom line.
Right, so the EPS goes up.
Yes. It's incredibly efficient capital allocation.
But it's not operational leverage.
Precisely. If I'm paying a premium multiple for a growth stock, and Synopsys is definitely priced for growth, I want the earnings beat to come from the fact that customers are tearing the product off the shelves.
Right, you want core business strength, not just the treasurer paying off the credit card early.
Exactly. The algorithm strips out that interest saving and asks, okay, operationally, did you raise?
And the answer is no.
No. They maintain the revenue guide range entirely, $9.56 billion to $9.66 billion.
So top line expectations are flat, right in the middle of the biggest AI boom in history.
And that right there is strike one against the stock tonight.
Let's talk about that top line, actually. Revenue for the quarter was $2.409 billion, which beat consensus by about $20 million. But the headline growth number is what jumps off the page, plus 65.6% year over year.
Yeah, but we need to put a giant asterisk on that for the listener.
Because of Ansys.
Right. If you just look at a screener, you might think this company is growing at NVIDIA levels, but that 65% is almost entirely inorganic.
You're just stapling Ansys onto the income statement.
Exactly. If you strip Ansys out, organic growth is healthy, likely in the low double digits, but it is absolutely not hypergrowth. This is fundamentally an M&A consolidation story right now.
And speaking of that consolidation, they also authorized a massive buyback, right?
$2 billion. A fresh authorization.
Okay, so they paid down $4.3 billion in debt. They authorized a $2 billion buyback. They are delevering incredibly fast. Total debt is what, $10 billion now?
Sitting right at $10 billion. It really shows the cash-generating power of this combined entity. They are essentially a utility company for the semiconductor industry.
Turn on the lights, collect the toll.
Exactly. The cash flows in, and they just pay down the mortgage. But again, delevering is a defensive move. It is not an offensive growth signal.
All right, I want to pivot to the macro narrative because I found the CEO's commentary fascinating.
Sassine Ghazi.
Yes, Ghazi. He spent a lot of time framing the entire year as what he called a tale of two markets.
It's a severe bifurcation, and we are seeing this across the entire supply chain right now, from the foundries down to the software guys.
Right. On one side, you have the AI supercycle.
Market A, the AI boom.
And what did he call the demand there? Insatiable.
Insatiable, that was the keyword. If you are in the business of AI compute, system-level architecture, or high-performance interconnects, business is absolutely begging.
The multi-trillion-dollar infrastructure build-out is just continuing unabated.
Totally unabated. Design starts are up. Chip complexity is off the charts. You have these hyperscalers, Google, Meta, Amazon, Microsoft, and they are all racing to build their own custom silicon.
And they're buying everything Synopsys can sell them.
Every advanced tool they can get their hands on.
But then there's market B, the rest of the world.
The traditional cyclicals.
Right. Automotive, industrial, consumer electronics. Ghazi called them subdued.
Which is very polite executive speak for dead in the water.
Yeah, that's what I thought too. It's interesting because for the last 3 years, the dominant narrative was that autos are basically becoming computers on wheels.
Right, the smart everything revolution.
Yeah, and the industrial Internet of Things was supposed to be this massive tailwind. And now those sectors are acting like an anchor.
Well, the smart everything thesis still holds water over a 10-year horizon. But cyclically, we are in a severe lull.
Why is that?
Auto inventory is sitting really high. The EV transition has stuttered dramatically in the last 18 months. Industrial CapEx is frozen because of interest rates.
And this is exactly where the Ansys acquisition gets tested, isn't it?
It is the ultimate stress test. Synopsys bought Ansys specifically to move from just doing silicon to doing entire systems.
So look into systems. That's their tagline.
Right. Ansys is the absolute king of physical simulation. Crash testing, fluid dynamics, heat dissipation for physical objects.
Right, digital twins.
Exactly. Companies cannot afford physical prototyping anymore. They have to simulate everything. But Ansys, his customer base is heavily weighted toward those industrial and automotive giants.
So by acquiring Ansys, Synopsys actually increased its exposure to those subdued markets at the exact moment they cooled off.
That is the deep irony here. They bought the perfect asset for the 10-year future, but they bought it right into a cyclical downturn for that specific asset class.
Ouch. And I bet that tension is visible when we look at the segment performance.
Oh, it's glaringly obvious.
Let's drill down into those segments then. We really need to get deep here because the devil is in the details on this print.
Let's start with the fortress. Design automation, which is their core EDA business.
The cash cow.
Revenue was roughly $2.0 billion. But the metric that really stops you in your tracks is the margin.
Hit me.
Adjusted operating margin stood at a robust 47.3%.
47.3%. That is incredible. That's approaching Visa and MasterCard levels of profitability. How do they even sustain that?
It's an incredible mix of software pricing power and, surprisingly, hardware leverage.
Hardware. Wait, we usually think of EDA as purely software, just lines of code for designing chips.
Right, but they are moving serious metal, the ZeBu and HAPS product lines.
Emulation and prototyping.
Exactly. We need to be clear about the competitive landscape here. In hardware emulation, it is a strict duopoly.
Synopsys and Cadence.
Right. Synopsys has ZeBu, and Cadence has Palladium. For years, the dynamic was that Cadence had the edge in pure speed, and Synopsys had the edge in total capacity. But look at these new AI chips, these massive reticle limit monsters with hundreds of billions of transistors. You physically cannot simulate them on a standard server farm fast enough.
It would take months.
Years sometimes. So you need hardware emulation.
So the hardware is essentially a highly specialized supercomputer that mimics the chip you're trying to build before you actually build it.
That's it. It's a physical digital twin. You have to emulate it. Because if you tape out a bad chip at 2 nanometers, you just lit $50 million on fire.
And nobody wants to be the guy who explains that to the board.
Exactly. You emulate first. Always. So the demand for ZeBu hardware is a direct derivative of the risk of failure in AI chips.
That makes perfect sense. And they mentioned a big win on the call, too.
Yeah, a marquee emulation win against an incumbent at a leading AI customer.
Now, they never name names.
They don't. But if you look at who is building the biggest AI chips right now, flipping an incumbent, which is almost certainly Cadence, is a massive signal that the Synopsys hardware stack is highly competitive right now.
And the software stickiness in ED is still there, obviously.
Oh, absolutely. Products like Fusion Compiler and Primetime are achieving basically 100% usage on critical tapes at 2 nanometer and below.
And the backlog.
Sitting at a massive $11.3 billion.
$11.3 billion. That gives them incredible visibility.
Yeah.
So EDA seems absolutely bulletproof.
Right.
But let's move to the new addition, Ansys.
Right, the new growth engine.
What was the revenue contribution there?
Ansys added about $886 million to the quarter.
That sounds huge.
It is, but we have to be very careful with this number. Synopsys specifically warned us about the seasonality here.
How so?
Ansys has a legacy fiscal year that ends in December.
Oh, I see where this is going.
Right. In enterprise software, the sales teams move heaven and earth to close every possible deal before December 31st to hit their annual quotas.
The classic budget flush.
Exactly. And because Synopsys Q1 covers that December period, they captured that massive spike. The $186 million is highly inflated. It's likely the high watermark for the entire year.
So investors should absolutely not just run rate this number.
Do not multiply this by 4. You will be severely disappointed.
Good to know. How is the actual integration going? Merging two distinct corporate cultures? Silicon engineers versus mechanical engineers is notoriously difficult.
Management claims the cost synergies are accelerating. They are cutting duplicate back office functions much faster than they modeled for year 1 and year 2.
Well, that's the easy part, right? Firing the redundant HR and accounting department.
Exactly. The hard part is the revenue synergies, the cross-selling. Can you actually convince a chip architect to buy a fluid dynamic software package?
Right.
They say those revenue synergies won't really start showing up until fiscal year 27.
But they did note that they are now supporting 90% of the top 100 automotive suppliers.
Which is a double-edged sword today. It means they have the footprint. When auto finally recovers, they will capture the upside.
But right now,
it means they are fully exposed to the procurement freezes at places like Volkswagen, GM, and Toyota.
okay, so we've covered the good, which is EDA, and the new, which is Ansys. Now we have to talk about the ugly,
The problem child.
the design IP segment.
This is the core bear case in a nutshell.
Revenue was $407 million, down 6% year over year, flat sequentially. And the margins,
It collapsed.
16.2% operating margin. For context, EDA is at 47%. IP is usually supposed to be this high-margin, sticky royalty stream. What happened?
It's messy. Management came out and explicitly called FY26 a transitional year for IP.
Oof. When the CEO says transitional year, grab your wallet.
It is the ultimate corporate euphemism for we messed up.
They admitted to execution issues, right?
They use the word prioritization. Essentially, the demand from hyperscalers for very specific interface IP. Think the high-speed plumbing that connects GPUs together, that demand was so high and the timelines were so aggressive.
That they had to pull people off other projects.
Exactly. They admitted they didn't have the resources aligned to deliver certain titles on time. They had to pull engineers from other roadmaps to put out the fire for the hyperscalers.
So they were basically understaffed.
Or just severely misallocated. They missed deadlines. They had to delay other product launches to satisfy this insatiable AI demand.
But that sounds like a pure management failure, not a macro market failure.
It is an execution stumble, plain and simple. And because of that, the revenue recognition gets pushed out. They are now promising what they call a Q4 weighted recovery.
Q4 weighted. That terrifies me as an investor.
Right. It means we promise we will fix this by the end of the year, just trust us.
Yeah, if they miss Q4, the whole year is a wash.
Exactly. It turns the stock into a show-me story. You have to prove it before the street gives you the multiple back.
But there's a strategic pivot happening in the IP segment too, right? They are divesting the ARC processor business.
Yes, selling it to global foundries.
I found this really fascinating. ARC is their CPU architecture. Why sell it? And why does global foundries even want it?
This is actually Synopsys admitting defeat in the processor wars. And I actually think it's a very bullish move long term.
Really? Admitting defeat is bullish.
Hear me out. Look at the landscape. On the high end, you have ARM. They totally own the mobile market and increasingly the data center market.
True.
And on the low end, the embedded side, you have RACV taking over because it's open source and free.
So ERC was basically getting squeezed in the middle.
ARC was a Me Too product in a world that simply does not need another proprietary instruction set.
Oh, okay.
By selling it, Synopsys is throwing in the towel on compute and saying, we are not a processor company, we are a plumbing company.
They want to own the pipes.
Yes. They are doubling down on interface IP. PCIe, DDR, Ethernet, CXL. The interconnects. In the AI era, the bottleneck is rarely the speed of the individual chip anymore. It's how fast those chips can talk to each other across the board.
Right. Data transfer is the bottleneck.
So Synopsys wants to own those high-speed links. It is a very smart strategic pruning.
But the divestiture creates a lot of noise in the financials for this year.
It does. It clears the deck long term, but it leaves them with a 16% margin business in the short term.
Which they claim will bounce back once the new high-speed IP titles launch in the second half.
Again, show me.
Fair enough. Let's shift gears to the tech frontier. We can't get through an earnings call in 2026 without talking about AI.
The obligatory buzzword segment?
Exactly. They were talking about the agentic shift. But honestly, this felt a little different than the usual generative AI marketing fluff we've been hearing for 2 years.
It did feel different. There is a palpable shift happening here. We are moving from generative AI, which essentially just helps a human write code, to agentic AI, which actually performs tasks autonomously.
They laid out this really interesting L1 to L5 roadmap, basically borrowing the terminology from autonomous driving.
Right. Level 1 is just knowledge assistance, a chatbot. You ask it, how do I use this EDA tool?
Level 2.
Task agents. You tell it, run this specific script. Level 3 is orchestration. You say, take this block of design, verify it, and tell me if it fails.
And L5.
Full autonomy. The AI acts as the engineer.
And where are they right now?
They are solidly in L1 and L2, pushing into L3. Customers are already seeing 50% faster knowledge assistance, but the big number is 5 times faster test bench generation.
Test bench generation.
Yeah, verification. Checking if the chip actually works before you build it. That process takes up about 70% of the total time in chip design.
70%.
Yes. If you can use an AI agent to generate those test cases 5 times faster, you fundamentally change the economics of the entire semiconductor industry.
And speaking of economics, this leads to the most radical thing they hinted at on the call, monetization.
Yes. This is the aha moment for the stock. Management explicitly signaled a move away from time-based licensing toward value-based or token-based pricing.
Let's unpack the implications of that because it is massive.
Yeah.
The current model is I sell you a software license for a year, you use it 24/7, or you use it once a month, I get paid the exact same amount.
Correct. It's a standard seat license. It's tied to headcount.
Right.
But if an AI agent is suddenly doing the work of 3 human engineers, Synopsys does not want to sell you just 1 seat license for that agent.
Because they lose money as your headcount shrinks.
Exactly. They want to be paid for the output. If the agent runs 1 billion inferences to verify your chip overnight, they want to charge you per token or per successful verification task.
That aligns their revenue with the customer's actual productivity, not just their employee count.
Right, because if AI really works, engineering headcount at these hyperscalers might actually go down or at least flatten out.
Yeah.
If NVIDIA hires fewer junior engineers because the AI is so good, Synopsys loses money on a seat model.
But on a token model, they capture the upside of the AI's speed.
It is effectively a tax on compute.
That is the holy grail for SaaS companies.
It is. But it is also incredibly risky. Customers absolutely hate uncertainty in their billing. They like predictable annual contracts.
True. Nobody wants a surprise cloud bill.
Yeah.
But if the value proposition is, hey, we just saved you 6 months of development time and got you to market faster.
They will pay the tax. The hyperscalers will pay it because time to market is everything right now.
They also touched on the NVIDIA partnership. Ghazi emphasized this is, quote, not a press release partnership.
Yeah, that was a direct shot at some of their competitors. There are two layers here. First, they are aggressively porting their EDA tools to run natively on NVIDIA GPUs instead of traditional CPUs.
And the speed up on that.
They are claiming 15 to 20x speedups.
15 to 20 times faster. That's insane.
And it ties perfectly back to the pricing shift we just talked about. If I can run a verification job in 1 hour on a GPU that used to take a full day on a CPU, Synopsys is absolutely going to charge a premium for that acceleration.
Right. Price discrimination based on speed. You want it fast, you pay more token.
Precisely. And the second layer of the NVIDIA partnership is Omniverse.
Integrating Ansys physics into NVIDIA's digital twin platform.
Exactly. Building virtual factories and testing them before a single brick is laid.
Okay, we need to touch on one last structural headwind before we wrap up the core analysis. Geopolitics. Specifically, China.
The perennial question mark for the semi-space.
Now, they reported that overall China revenue grew 21%.
But we know that's the Ansys illusion.
Right, because of the consolidation. What did organic China look like?
Organic China legacy Synopsys was actually down slightly year over year.
And the cause there is obvious. The U.S. entity list. Export restrictions.
Yes, technology caps. Synopsys legally cannot sell its most advanced AI-capable tools to restricted Chinese entities. But there is a secondary issue here that's more insidious. It's a mix issue.
Explain that.
Chinese chip designers are increasingly shifting to domestic foundries like SMIC, right?
Because they have to. They can't use TSMC for the high-end stuff anymore.
Exactly. Now, this specifically hurts the Synopsys IP business. Synopsys interface IP is heavily optimized for the global Tier 1 ecosystem. TSMC, Samsung, Intel.
Okay.
If a Chinese chip designer is forced to use a domestic foundry, they might not be able to use that Synopsys IP. The attach rate of Synopsys products drops dramatically when the supply chain goes domestic.
Because the domestic foundries require different standards or domestic IP.
Yes. It creates a massive vacuum. And domestic Chinese EDA competitors are popping up to fill it.
Are they actually competitive, though?
Not yet. Synopsys is still the absolute gold standard. Customers prefer Synopsys, but if they are legally banned from using it or if it doesn't work with their local foundry, they are forced to switch to local tools.
So every time the U.S. tightens the screws on export controls, it effectively subsidizes the creation of a non-Synopsys software stack in China.
That is the geopolitical reality. The gap is narrowing because it has to narrow.
Wow. Okay, let's bring this all back to the investor context.
Yeah.
We started by asking why the stock is down 5% in the after hours. Is the market right to sell this off?
I think the market is reacting very rationally to uncertainty.
How so?
Think about the three big red flags. Reason one, the quality of the beat. The EPS raise was driven by lower interest expense from paying off debt, not by selling more software. That is low quality upside.
Right.
Reason two, the IP drag. Investors despise uncertainty. IP being down 6% when AI is absolutely booming globally suggests severe execution errors. And that second half recovery promise is a massive show me story.
And reason three.
Valuation versus growth. Synopsys has a double-digit growth profile, but it trades at a massive premium. The market demands perfection. A transitional year in IP combined with subdued industrial markets equals multiple compression.
It's hard to argue with that logic. But let me play devil's advocate. What is the bull counter-argument right now?
The bull case is structural dominance. The backlog is $11.3 billion. They are the only player on Earth with a full silicon-to-system stack now that they own Ansys.
And the balance sheet is pristine.
Exactly. The debt is being paid down rapidly. $4.3 billion gone. That opens the door for that $2 billion buyback to actually provide a floor for the stock. If you have a 3-year time horizon, you look at this and say, they dominate the most important value chain in human history.
Chip design.
Right. The agentic shift is real. The Ansys integration will eventually bear fruit. This is just a stumble, not a fundamental fall.
So it all comes down to your time horizon.
As always in this market.
All right. We've dissected the past, we've analyzed the present, and we've speculated on the technology. Now it is time to get a little reckless.
Let's do it.
It is time for our favorite segment of the deep dive. This is not financial advice.
Standard disclaimer applies here, folks. We are barely qualified to order lunch, let alone manage your retirement portfolio.
Right. This is for entertainment purposes only. Do not trade on anything we say.
Seriously.
But if you were looking at this earnings print and you wanted to construct a trade that captures the real essence of what we just discussed, that massive bifurcation. What is the play?
I call this trade the toll booth of physics.
Okay, I'm listening. Walk me through the setup.
We established that the hyperscalers, Google, Meta, Microsoft, are all becoming their own custom chip designers. They have to do it to control their data center costs.
Right, they can't just keep buying off-the-shelf NVIDIA chips forever.
Exactly. But here's the catch. They do not have the 30 years of deep institutional memory that an Intel or an AMD has.
So how do they catch up?
They rely entirely on Synopsys IP and these new agentic AI tools to replace the senior silicon engineers that they literally cannot hire fast enough.
Synopsys essentially becomes their outsourced R&D department.
Correct. And on the flip side, the physical world, the companies building robotics, aerospace, next-gen EV platforms, they need Ansys to simulate reality before they spend billions bending metal.
So what's the actual trade?
You go long Synopsys, ticker SNPS.
Okay.
But you pair it. You hedge it by going short a basket of legacy Tier 1 auto suppliers and generic OSAT firms.
Wait, OSATs, outsourced semiconductor assembly and test.
Yes, the companies that just physically package the chips.
Oh, I short them.
Because the value capture in the tech world is moving upstream. The real margin, the real value, is entirely in the design phase and the simulation phase.
The intellectual property.
Exactly. It is moving away from the physical stamping of metal parts or the simple commodity assembly of silicon packages. Synopsys is raising prices. They are moving to token-based billing. They are taxing the innovation directly.
And the suppliers at the bottom of the chain are just getting squeezed on margin. So you buy the tax collector and you short the taxpayer.
Exactly. You are basically buying the IRS of the semiconductor world.
The IRS of Silicon Valley. I love that analogy.
And the wild kicker here. If Synopsys actually pulls off this token-based pricing for their AI agents, they essentially uncap their upside. They stop being just a flat-fee software vendor, and they become a direct partner in the output of the entire global AI economy.
That is a massive paradigm shift. What's the timeline on this trade?
Target the Q4 recovery in the IP segment. If they hit those Q4 weighted targets that management promised, the stock re-rates back to all-time highs.
And if they miss?
Well, that's why we use stop losses.
Fair point. All right, we need to wrap this up just to recap the high points. Strong headline numbers today, but they are masked by inorganic growth from Ansys. The Ansys integration seems to be the star of the show right now, while the core IP execution is the big concern dragging the stock down.
Right. And China remains a structural headwind, but the sheer force of the AI supercycle is compensating for a lot of those sins.
It definitely is.
Yeah.
Which leaves us with one final thought to mull over.
Lay it on me.
Is fiscal year 26 really just a transitional year for their IP segment, or are we looking at the exact moment Synopsys stops being a tool provider and starts being a fully autonomous engineer provider?
I am betting on the autonomous engineer. The L5 shift is going to change everything.
We'll see if the market agrees in the coming months. Keep your eyes on the tape, everyone. This has been a Talk Tickers Deep Dive.
See y'all next quarter.